In the often chaotic world of the stock market, where fortunes can be made or lost in the blink of an eye, the story of Michael Burry stands as a testament to the power of independent thought and rigorous analysis. Known to many as the Big Short, for his incredibly successful bet against the subprime mortgage market prior to the 2008 financial crisis, Burry has carved out a reputation as a contrarian investor with a knack for identifying undervalued assets and market irrationality. His approach, deeply rooted in the principles of value investing, offers a compelling counter-narrative to the speculative frenzy that often dominates market headlines. One of Burry's more recent and widely publicized moves was his significant bet against Tesla. He purchased a substantial number of put options on the electric vehicle maker's stock, a move that raised eyebrows and generated considerable media attention. A put option gives the holder the right, but not the obligation, to sell a stock at a predetermined price within a specific time frame. This is a bearish position, indicating a belief that the stock's price will decline. The media often highlighted the notional value of these options, which can be a staggering figure, but it's important to understand that this represents the total value of the shares the options control, not the actual amount Burry invested. The premium paid for the options, which is the true cost of the position, is typically a fraction of the notional value. While the exact details of Burry's Tesla trade remain undisclosed, the sheer volume of the options he purchased signifies a multi-million-dollar commitment, a clear indication of his strong conviction that the stock was overvalued. To understand how Burry arrives at such bold and often contrarian conclusions, one must delve into his investment philosophy, which is heavily influenced by the teachings of Benjamin Graham, the father of value investing. Graham's core tenets, which Burry has adopted and adapted, revolve around the concepts of intrinsic value and a margin of safety. This philosophy emphasizes a clear distinction between the price of a stock and the underlying value of the business it represents. The idea that price and value can diverge is a fundamental concept in value investing. In a perfectly efficient market, a company's stock price would always reflect its true worth. However, the real world is far from perfect. Market prices are often swayed by a multitude of factors that have little to do with a company's long-term fundamentals. Investor sentiment, herd behavior, and short-term news cycles can all contribute to significant discrepancies between a stock's price and its intrinsic value. A prime example of this disconnect can be seen in the meteoric rise of stocks like Tesla, which saw its price increase by over 500% in less than a year. It is highly improbable that the intrinsic value of the company increased fivefold during that same period. This is not to say that Tesla is inherently a poor investment, but it serves as a powerful illustration of how market price can become detached from underlying business performance. This is where the core of value investing lies, identifying these discrepancies. A value investor seeks to buy assets for less than their intrinsic worth. This principle can be applied across all asset classes, from traditional boomer commodities to the more volatile world of cryptocurrencies like Dogecoin. While many traditional value investors might dismiss something like Dogecoin out of hand, a true student of Graham, like Burry, would approach it with a framework of value and risk assessment. The challenge with assets like Dogecoin is the difficulty in quantifying their intrinsic value and accurately modeling their risk. However, for those who can develop a robust model for its supply and demand dynamics, there could be significant opportunities, precisely because fewer market participants are conducting such rigorous analysis. The fundamental idea is that inefficiency in the market creates opportunity. The more turbulent and less understood a market is, the greater the potential for mispricing. A good value investor doesn't shy away from volatility, but rather sees it as a potential source of undervalued assets. However, simply identifying a discrepancy between price and value is only half the battle. A stock can remain undervalued for an extended period, and there's no guarantee that its price will ever converge with its intrinsic value. This is where the concept of a value catalyst comes into play. A catalyst is an event that can propel a stock's price, causing it to move closer to its true worth. Examples of catalysts include new product launches, changes in management, industry-wide regulatory shifts, or even the involvement of an activist investor. Interestingly, Burry has stated that he doesn't place a heavy emphasis on catalysts. He believes that if a stock is outrageously undervalued, that in itself is a sufficient reason to invest. The sheer magnitude of the discount to intrinsic value provides a compelling investment case, regardless of any specific foreseeable event. Nevertheless, understanding a company's historical catalysts can provide valuable insights. By examining a stock's historical price chart and cross-referencing significant price movements with news and events from those periods, an investor can gain a better understanding of what has driven the stock's performance in the past. The cornerstone of Burry's strategy, and indeed all value investing, is valuation. The process of determining a company's intrinsic value can seem daunting, but at its core, it is a skill that can be learned and honed with practice. Burry has indicated that one of his primary screening tools is the EV/EBITDA multiple. EV/EBITDA, which stands for enterprise value to earnings before interest, taxes, depreciation, and amortization, is a valuation multiple that allows for a relative comparison of companies. It provides a more comprehensive view of a company's value than a simple price-to-earnings (PE) ratio, because it takes into account both debt and equity. To understand EV/EBITDA, it's essential to break down its components. Enterprise value, EV, is a measure of a company's total value. It is calculated by taking the company's market capitalization, the total value of its outstanding shares, adding its total debt, and subtracting its cash and cash equivalents. The inclusion of debt is crucial because if you were to acquire a company, you would also be responsible for its outstanding debts. The subtraction of cash is based on the logic that this cash is not a core part of the company's operating assets and could be used to pay down debt or be distributed to shareholders. EBITDA, on the other hand, is a measure of a company's operating profitability. It starts with a company's earnings and adds back interest, taxes, depreciation, and amortization. By excluding these non-operating and non-cash expenses, EBITDA provides a clearer picture of a company's core operational cash flow. By combining these two metrics into the EV/EBITDA multiple, investors can compare the valuations of different companies, even if they have different capital structures, i.e., different levels of debt or tax rates. A lower EV/EBITDA multiple relative to a company's industry peers might suggest that the company is undervalued. Burry uses this multiple as a starting point for his research. By screening for companies with low EV/EBITDA ratios within a specific industry, he can identify a list of potentially undervalued investment candidates. Numerous free online tools, such as stock screeners on financial websites, allow anyone to replicate this process. These screeners enable users to filter a vast universe of stocks based on various criteria, including EV/EBITDA, to narrow down the field to a manageable number of companies for further investigation. It's crucial to remember that a low EV/EBITDA multiple is not, in itself, a buy signal. It is merely a starting point for a much deeper dive into the company's business. Valuation is just one piece of the puzzle. A comprehensive understanding of the business, its competitive advantages, the quality of its management, and its long-term prospects is equally, if not more, important. One of Burry's most famous contrarian plays that exemplifies his deep value approach was his investment in GameStop. He began accumulating a significant position in the struggling video game retailer in 2019, long before it became a meme stock and the subject of a massive short squeeze. Burry saw value where others saw a dying brick-and-mortar business. He identified that the company's cash on hand and the potential for a share buyback program made the stock significantly undervalued. While he ultimately sold his position before the stock's meteoric rise in early 2021, his initial analysis was rooted in the same principles of finding unrecognized value. He recognized a discrepancy between the market's perception of the company and its underlying financial reality. In terms of portfolio construction, Burry has suggested that holding around 15 to 20 stocks provides a good level of diversification. The primary goal of diversification, in his view, is not necessarily to maximize returns, but to preserve capital and mitigate the impact of bad emotional decisions during periods of market volatility. By spreading investments across a number of carefully selected, undervalued companies, an investor can reduce the risk associated with any single position. In conclusion, Michael Burry's investment strategy is a powerful testament to the enduring principles of value investing. His success is not a result of some arcane, inaccessible formula, but rather a disciplined and rigorous application of fundamental concepts. He seeks out unrecognized value, often in unpopular and overlooked corners of the market. His approach is built on a foundation of thorough research, independent thinking, and a commitment to understanding the true worth of a business. While the world of finance may have become more complex and the tools of analysis more sophisticated, the core tenets of value investing, as championed by Benjamin Graham and practiced by investors like Michael Burry, remain as relevant as ever. The pursuit of a margin of safety, buying a dollar's worth of assets for 50 cents, is a timeless strategy that, while not a guarantee of success, provides a sound framework for navigating the inherent uncertainties of the stock market. For those with the ambition and dedication to learn and apply these principles, the path to successful investing, while challenging, is not an insurmountable one.